Hello, and welcome to Pitt Street Research. My name is Stuart Roberts, and I'm one of the co-founders of our firm. And joining me from Sydney on the morning of Wednesday, the 2nd of July, 2025, is Mr. Philipp Kin, who's the Managing Director of Helios Energy, ASX HE8. Philip, good morning.
Good morning, Stuart. Great to be here.
And Happy New Year, financial year 25. May it be a
Indeed.
great year for Helios Energy.
Considering how we've progressed so far, I hope we'll just be on an upwards trajectory from here.
Let's paint the picture. 2017 or thereabouts, Helios Energy picks up a working interest in a project called the Presidio Project.
That's correct.
Presidio County is about as far south and west as you can get in the state of Texas and still be in the United States. It's the Mexican border on the other side. Uh,
Correct.
More importantly, it's part of what's called the Marfa Sub-Basin of the world famous Permian Basin of West Texas. So the Permian accounts for about half of all U.S. oil production. The Marfa Sub-Basin is a little bit off the beaten track. People don't talk about that as an oil province from within the Permian. You hope to change that.
That's correct. So when the company was formed in 2017, it was formed under a geological underpinning, an idea that these basins extended, but there was also enhanced petroleum play, which was actually a hockey stick kind of forward coming from the Eagleford. This is for Australian circumstances, not particularly remote, but for Texas circumstances is considered remote. So very, very limited drilling was done in this area. And Helios put their foot down on a significant amount of acreage, and then in the meantime drilled 4 wildcat wells, all of which discovered hydrocarbons and flowed hydrocarbons to surface. And over the course of those 5 years was going through the various processes of ramping up acreage, trying to define the resource. However, previous management, weren't able to quite crack the key. And as a result, they've asked me to come in November. Going forward, we've engaged with some very astute technical advisors, WD Van Gotten, who are very well known in the Texas space. Their job is to find new areas. They're currently looking in Argentina. And what we've got here in the Marfa Sub-Basin, the Presidio project, is of incredible interest to them, considering we've significantly de-risked it. So going forward, we anticipate that this is going to be something that the assets and the companies that are looking and trying to expand out of the Permian Basin and look for new places to play will be something of keen interest to them.
Right. So it interests me. We started with an idea that the Eagle Ford would swing around in a kind of circular fashion and end up in
Yes,
Marfa County of Texas, or Presidio County, I should say. So the four wells went down, and the Eagle Ford was looking interesting, but particularly the a lesser known formation called the Ojinaga, named after a basin in Mexico. And in the lower Ojinaga, when your consultants looked at the various formations, on the ground you're holding now, they're talking 17 million barrels of oil equivalent, oil, gas, and liquids, just in that small area of the project that you're still holding, but only in one
that's right.
bench in the Okanaga. And there's about 5 benches down there that are hydrocarbon rich. So there seems to be a lot of upside that you're sitting on right now.
Oh, absolutely. With regards to the drilling and the testing and the flow, majority of the 4 wells came from the lower, and it's pronounced Owanaga,
Okanaga,
not
right, right.
Owanaga section.
You can tell I'm a
As a
gringo.
result, yeah, as you can tell, the contingent reserves report contingent resource report, sorry, that we put down gave us the 17.5 million barrels on a 2C basis. That only accounts for about 40% of the actual hydrocarbon producing zones that we've discovered, and that only accounts over our gross acreage position of about 10,000 acres. At the height of the company's, let's say, kind of power, we were sitting on about 85,000 acres. As a result, though, the company didn't have enough money or funds and time to go and develop them and hold them by production. As the leases expired, the company's position whittled away. However, with the new information that we've got, with the new interpretations and work done by WD Van Gotten, we are currently in the process of highlighting and cherry picking what acreage we're looking for the next round of increasing our acreage position. Because, whilst people on the market assume that acreage position equals value, we've got to be just selective in the acreage we pick up to make sure that we're actually getting those sections that we need to target. So as we embark on our program, and as we increase our acreage position, we'll be increasing it with good acres, with things that we can further increase our contingent resource report. And then, as we go forward and do some further drilling, we'll be moving that from a 2C to a 2P, and then a 1P reserves
Right.
as we go forward.
So, studying Helios introduced me to some terminology I'd never encountered before. Entitlements enforced versus entitlements suspended. Now, the difference between those two is this company used to lease about 85,000 acres, now leases about 8,000. But underneath the 85,000, you've estimated 140 million barrels oil equivalent at 2P. So considerable upsize once you go and release all of the relevant acreage that covers that entitlements suspended category.
That is correct. As a result of Helios, we are first movers there. We have very, very good relationship with the landholders and the mineral lease owners, which was part of my trip that I've recently come back from with regards to going and chatting with them. They're very excited for us to release with them and to go forward. But you're absolutely correct with regards to the overall contingent, the large size of the pie that we've got there. The upside for us is considerable, and we've already got the legwork done with the lease owners to the extent that a lot of the leases we can literally just dust off the old lease schedules, update the date, make another kind of option payment or a lease royalty payment, and increase our acreage position quite easily. And as a result, that's put us in good stead with our landholders.
Right. So those four wells that drilled, obviously when you're wildcatting, you don't necessarily get ongoing production from the first day because in this era of unconventional oil and gas resources, one first has to understand where it's coming from. So the data from those is variable, but it's a reasonable bet that within the next year or so you'll be able to bring on at least one and possibly more of those wells back into production to further demonstrate the viability of the formations.
Sure, that's correct. The first we've drilled four wells. They're named after the permit names themselves, so not very imaginative there. We are actually in the process as we speak. I highlighted in my MD letter before I left to go to the States that we're actually in the process of restarting production on our 1411 and 1412 wells. That'll come out in a separate release, but with that production restarted, that'll give us further information, particularly for WD Van Gotten to interpret and understand which formations are producing which amount. The frac designs that were done on those wells are all vertical fracs, and as a result, a lot of the frac fluid hadn't been flowed back. The water cuts that they were previously getting and producing were about, oil cuts, 30 to 35%. We anticipate that as we continue to produce this well, if we put artificial lifts on them, we've also put remote sensoring on it as well. We anticipate that the oil cuts are going to increase to about 50%. And as a result, we're going to have some cash flow coming in on the company. No, it's not going to be a year. I am hoping that it's going to be far, far sooner than that. We've been doing work on production on 1411 and 1412. Think of it as restarting an old car. These facilities were shut in for a couple of years. They've been baked in the sun. It's like trying to start your old Kingswood. We've just got to go through, replace valves, replace some pipes, get the separator. We managed to go up and get the flare up and running. So the electrics have been updated for the flare. So I'm anticipating, fingers crossed within the next 2 to 3 months, we'll be having production from 1411 and 1412, if not sooner.
Right. And what impresses me, this is the Permian. So we're talking some of the most knowledgeable and enterprising oil men in the entire civilized world, emanating out of Midland, former home of two US presidents, as we both know. It's a reasonable bet that there's going to be some partnering interest in this project just from the local neighborhood, right?
Absolutely. We find ourselves, it's a curse and a blessing at the same time. We find ourselves in an area that is being looked over, that has been ignored, that people view as too hard. And as a result, that gives you the early mover advantage for the cheap acreage positioning and being able to apply kind of new thinking geological kind of interpretations. But it also makes it difficult, even when you've got production and even when you've got kind of, proof of the pudding, so to speak, to actually get people interested. Hence why one of the first things we did was to get WD Van Gotten, because if WD Van Gotten gives its seal of approval and says there's something here, and they have, That is what interests a significant amount of parties for a farm-in. Ideally, my strategy would be here to accumulate a significant acreage position and then utilize that acreage position plus our kind of exploration results, our production results, to utilize that to go on a further kind of drilling campaign and or a farm out to a large player like an EOG or a Hillcorp or a Chevron or someone like that. Because as we've seen in the Permian, a lot of the companies are starting to kind of run out of their A stock, and they're starting to go into kind of B areas, C areas, just to continue that continual production requirements as we've gone. And we think the Marfa Basin and the Presidio project is ideally suited for that.
Right. The company over time spent something like $70 million developing the project, which included those four wells, 2D and 3D seismic. You probably have to gather some more seismic as you build this project out a little further. But how expensive is a typical well and then multi-stage frac in a place like this?
It's really difficult to give you a kind of exact number due to one of the things that we have here is it's a fairly remote location. So just driving out there takes a little bit of time. Our estimations with regards to dry hole costs vary depending on what we're looking to do. My next aim is to drill a proper deep well because we've reached the horizon of about 10,000 feet, but we don't know what's below 10,000 feet. And there's different geological assumptions that there might be Wolf Camp or there might be some further Permian actual plays below the deepest point of the wells that we've got. And due to the fact that no one's ever drilled out here, well, there's been 16 wells historically in the history of the United States. No one's gone below that 10,000. So with regards to what I'm looking to do would be to drill another pilot test well with coring, side core sampling, logs, and then also drill down further to where my geologists say we'll hit actual base rock, which will also help us realign our seismic. And a cost for that would looking be about $5 million US. But then also depending on how we structure it, I'd be looking to then come up and use that well to potentially side core well into say the lower Onaga and do a perforation and a frac job, which I can't give you a figure as to how much that will cost at the moment because it depends on the size of the frac, what we're looking to do, and what sort of data we're looking to assess. But at the moment, that's the kind of costs we're looking at.
Right. But what's interesting is Permian places often talk about Wolf Camp, the Wolf Camp play, as being an important recent play in the Permian. And if it shows up here as well, a lot of people are going to be pricking up their ears.
Absolutely. If we drill down past our deepest part and find Wolf Camp or find any other shale plays that are prolific in other areas, what will demonstrate and what will prove is that it's a geological extension of those plays into the sub-basin there, on top of the lower Onaga and on top of also the Austin Chalk and the Eagleford that we've got, which are also producing sections as well. So once we prove that, we anticipate there's going to be significant amounts of interest, and there'll also be something that we'll be no doubtedly telling everybody, shouting from the rooftops.
Now, you and I first met in Perth at the Good Oil meeting. It would have been October 2019.
Seems like a lifetime ago.
There was a certain event intervened there between 2020 and 2022. But for investors who don't know you, a lot of your time has been spent on the debt side of the oil and gas space. Give us a brief picture of your career so far.
I'll give you a brief picture. I'm actually Perth. I grew up in Perth. I initially cut my teeth in the oil and gas business as a Shell graduate. So I got on the Shell graduate development program at Shell, working in business analytics and economics for Shell on the Gorgon LNG project, Northwest Shelf, exploration, onshore, offshore, you name it. Shell effectively gives you a very good technical underpinning. So I'm not a technical guy by background, but I know enough to be dangerous. Then moved over to Sydney and became a research analyst for Royal Bank of Scotland and Canaccord, so covering the large cap to mid-cap oil and gas spaces. You and I would be familiar with a lot of them, Woodside, Santos, Oil Search when it was still around, and AWE and all those. Also covered the small end of the market as a research analyst, and then afterwards moved into equity capital markets. So I was doing equity capital markets for a little while at Bailey Holst. Post that, I also did a stint at Oil Search for a year as investor relations for 2IC for investor relations. So I've got the investor relations side of things. And then my latest, before I became MD of Helios, I was doing debt capital markets. So everything from project financing to Nordic bonds to, asset-backed securities, convertible notes, everything from your senior right through the mezzanine level of debt. And then before I joined as MD, I was consulting to various oil and gas firms because, as you know, the oil and gas industry in Australia is very small. And when the opportunity to become the MD of Helios and then turn it around came up, I couldn't say no. So I've been running at 100 miles an hour since November, but it's been a good ride so far.
So, Pitt Street Research has recently published some research on Helios that you've commissioned for us. We've got some stock in this company, so we're quite optimistic about the upside, and we think there's still upside based on where the current share price is and where this project can get to. What do you hope to achieve by Christmas of this year? About 6 months away.
6 months away, ideally, I would like to have 1411 and 1412 on continuous operations producing oil, gas, and non-gas liquids. I would like to be more progressed with regards to the technical planning and underpinning of our next well in the area. I'd like to have our acreage position at least doubled. With regards to signing up new leases and having good acreage under our control. And ideally, I'd like to have the share price at least 2 to 3 times higher than it is currently
Now
by
you're talking
December.
my language here.
Not hard goals to achieve, but those are my key strategic items. Recently, in my trip back, I came back from the US about 3 days ago. I've appointed a chief geologist. I've got a chief operating officer. We've got a chief petrophysicist. We've got a CFO who's got not only is he just a CFO, he's a CFO who runs his own oil and gas wells. He has his own ranch. So with regards to having expertise, and he's Texan born and bred. So with regards to having expertise on the ground from a financial perspective, I've got a guy who actually does this for a living and not just a spreadsheet guy. So we've got the team, we've built the team back up, we've rectified the issues from the past. It's new management on deck. Everyone's aligned. I've got a very strong board who's very, who supports us very, very strongly. We've got some significant heavy hitters on our register, disproportionate to our size. So I think all in all, the stars are all pointing in the right direction. We just all have to pull. And so far, everyone's just working really hard to get that done.
There's one thing you need, Philip, and that's a cowboy hat. This is Texas.
I was considering buying one when I was over there, but believe it or not, the amount of different customizations you could get for a cowboy hat is it's amazing. It's all different types. You can have them custom made and different skins and everything. So, but I will, if we're successful by the end of this year, I think I'll buy myself a cowboy hat for the next interview.
All right. Speaking Texas for a moment, you all want to take a look at the research we've written on Pitt Street Research. And Philip, thanks for joining us to talk about the upside today.
Sure, my pleasure. Thank you.
Thank you.